You're listening to the Cash Podcast, creating affluence, success, and happiness with your financial surgeon, Adam Koos, President and Portfolio Manager at Libertas Wealth Management Group at libertaswealth.com.
Trust me, this is a topic that's very important, and in the rare circumstance this comes up at our office, it's always an extremely informative conversation. And honestly, for that reason, I wish it would come up more, but at the same time, I don't. So after having just the other day one of these conversations, which again, doesn't come up that often, I thought it would make a great topic to share with everyone via the podcast here. And I'll probably turn it into an article as well, because it needs to be written, it needs to be shared, and all of you need it to reframe your brains and get in a place that helps you become better investors and more retirement ready. So let's get into it here. But before we get started, as always, a few housekeeping items. If this is your first time listening or watching, then thank you for joining us. I'm Adam Koos, President, Portfolio Manager, and Senior Financial Advisor at Libertas Wealth Management Group. And you're listening to the soon-to-be renamed and rebranded Cash Podcast. While the name is going to change, you're still going to be the first to get these updates if you subscribe. So please be sure to click that link and subscribe on YouTube, Twitter, Spotify, and you can follow me on Twitter at Adam Koos, as well as Instagram at Adam D. Koos, or Adam D. Koos. If you'd like to schedule an intro call to confidentially discuss your financial situation in more detail, or if you'd like to get a second opinion on your retirement plan and or investment portfolio, head over to our website at libertaswealth.com. Just click on that button that says click here to get started. And you'll be able to submit a form, and or somebody can reach out to you, get something set up on our calendar. Last but not least, of course, all links, visuals, charts, and other educational resources are always available on our website. And if you're listening on iTunes or Spotify, you can always head over to YouTube and watch this presentation where you can stop, pause, rewind, check out the charts. And today I have only got 3. So on purpose here, I'm going to talk you through everything, but on purpose, again, keeping it short, keeping it to the point. But this is a pressure cooker of short but very powerful, good information. So I hope you enjoy. Let's go ahead and get started here with a quote of the day as usual. This is Benjamin Graham, economist, author. He said, "The best way to measure your investing success is not by whether you're beating the market, but by whether you've put in place a financial plan and behavioral discipline that are likely to get you where you want to go." So right off the bat, I know the title of this thing is Outperforming the Stock Market. We're going to be talking specifically about what's called home country bias, or another phrase for it, a word for it, is called familiarity bias. But what Ben Graham here is saying, and he was a legend in the industry for value investing, he is saying, as somebody who was a money manager, he's saying the best way to measure your investing success is not by whether you're beating the market, but by whether you've put in place a financial plan, and if you have a behavioral discipline that helps you stick to that plan and helps you get to where you want to go, do the things you want to do with the people you want to do them with the least amount of stress possible. Now, of course, I just expanded on that quote a little bit, but I think we're all those are the things we're all looking for. I think you would probably agree with me. In other words, I've never had somebody that came up to me ever in my career and said, "Adam, I really don't care all that much about my spouse or my partner. In fact, I don't really care about my kids either. Grandkids, they don't mean a whole lot to me. My goal in life, the single biggest thing that I want to do in life is to beat the stock market, to beat the S&P and the NASDAQ every quarter. And if I can do that, I'll be happy." Nobody's ever said that, ever, and they never will. At least, well, a happy person will never say that. So let's move on here, and let's start by talking about home country bias. Well, what is home country bias? What's this mean? Well, what you're looking at here, and for those of you listening on Spotify, iTunes, or other medium, our website, what we're looking at here is a chart of a bunch of different countries and their domestic equity allocation as a percentage of total stock investing by residents of that country. So if I look at the far right, we can see Austria, and you can see the people in Austria have about 25% of their money invested in Austrian stock index. If I scroll over a little bit more, I'm going to pick one that's right on a line here. We can look at, let's see, we'll say Hungary, Chile, Israel, Canada. All of them kind of hover around the 50% range. So in other words, 50% of those in Hungary, which is where my dad is from, invest their money in their domestic index. If I scroll over to the United States, In the United States, about 75% of the amount of money that's invested here amongst investors in the United States, 75% of our money is invested in the U.S. stocks, whether that's the S&P 500, the NASDAQ, the Dow, the Russell 2000, doesn't really matter. The point here is that the United States, and in the case of our country, 75% of our money or investors' money here in the United States is invested in their home stock index. If I keep scrolling over, it gets heavier and heavier. So, for instance, in China, when you look at the population there, more than 90% of their money is invested in their domestic index, in the Chinese stock index. If we keep going, we can head over to Turkey, India, Bangladesh, where almost 100% of their money is invested in their domestic index. So why am I sharing all this? Before I tell you why, let me share one more chart with you. Again, I've only got 3 today, so listening to this podcast is 100% acceptable. This one's a little blurrier anyway. As you can see, I tried to blow it up, and it wasn't exactly the biggest table in the world. So we're looking at big countries here. So this kind of splits it up into just the 5 big countries here. We're looking at the United States, Japan, Australia, United Kingdom, and Canada. And when you look at the different tables here, the different bars on this bar graph or this table, which again, if you're listening on iTunes, on Spotify, or any other medium, you don't really need to be looking at this chart. I'm just going to walk you through it. But what we're looking at is that I'll just go from left to right. The global index weight, in other words, the all country world index back in 2019 was allocated about 3% to Canada. So in other words, if you were to invest your money in the all world index, the MSCI all country world index, you would have a 3% investment in the Canadian stock index. If it was the United Kingdom we were looking at, it'd be 5.6%. Australia would be 1.9%, Japan 7.3%, and then 54.7% of that index is made up of the United States. If I back up and we go back, though, if we look at the amount of money that's invested, for instance, Canadians. So when you look at all Canadians, they have 59% of their own money invested in their index. And that's relative to the 3% or so that is invested in the all country world index. When you look at the UK, they have 26.3% of their money. And this is, again, a little bit old information, but 2019, 26% of their money was invested in their domestic index versus 5.6% across the world. Australia, 66.5% of their money invested in their own index versus 1.9, almost 2% for the rest of the world. Japan invests 55% of their own money into their own index, their own stock market index, as opposed to 7.3%, which is the biggest so far. And again, almost 55% of the world index is invested in the U.S., but get this, 80%, almost 80%, 79.1 as of this study is here in the U.S. 79.1% of our money is invested in our home country index. What that tells us is that we're talking 20% of the money is invested overseas. And I would argue, by the way, that this is probably not the best study. I think when I look at portfolios that come into our office, usually from other firms, that is, so when people leave, whether that be another financial advisory firm, whether it's coming from their 401k, or if they have a 403b, or it doesn't really matter. Whatever their investments are that they own now before they come over to our office, usually it's 100% of the amount of money they have invested in stocks is typically invested here in the U.S. Very rarely do I see a lot of money invested overseas. And then, of course, there's the bond allocation, which is a completely different subject here. But anyway, I just wanted to point out that even though this is saying 79.1%, I'm not so sure how good of a representation that was back in 2019. Although I would believe that today it's probably a little bit higher. And here's why. And here's the lesson, or here's the point of the conversation, and why home country bias is so important. And again, for those of you on YouTube, those of you on iTunes and Spotify, I'm going to talk you through this here. It's all about outperformance. So we're talking about outperforming the market. I'm going to say, and I'm going to be careful how I say this, it is much, much easier to beat the stock market when the market is going down. I'm going to start there. So last year, 2022, even 2021, we did pretty well. Last year especially did extremely well. And a lot of that has to do with the fact that the market went down. And when the market struggles, whether that be the NASDAQ, down more than 30%, the S&P 500 was down as much as almost 27% on an intraday basis throughout the year, closed down over 18%. When you look at bonds, last year, bonds were down more than 16%. If you look at the aggregate bond index, the AGG. So even bonds didn't help you last year. So those conditions, when things are not going well, it has been I don't want to say just my opinion, it's been my experience that it is much, much easier to beat the market when it's going down than it is to beat the market when it's going up. Now, with that being said, I will throw one caveat out there, and that is this. It is much easier to beat the market when international stocks or stocks in other countries are outperforming the US. But why is that? And this is where the light bulb goes off, by the way. These are the conversations, like I was saying in the intro, that are so interesting and to me even exciting when we start talking to clients and prospective clients, or just doing speaking engagements in the public, and we start talking about the concept of outperformance or beating the market. So much of it really has to do with whether or not the U.S. is performing the best or if somebody else is. Because if the United States stock market is the best performing market, which, by the way, it has been for more than 15 years now, going back to the end of the last big, huge, catastrophic bear market being 2007, 8, and 9, the mortgage crisis. So it's been that long that the U.S. has generally just been outperforming all other stocks. And as a result of that, when people talk about beating the market, they, of course, are talking about beating their own market. But let's change the game here for a second. What if you just happen to live someplace like the UK? What does beating the market mean to you? Does it mean you have to beat the UK index, or do you have to beat the United States index? I would argue that wherever you live, chances are when you talk about beating the market, you're talking about beating the market in the country in which you live. Because if that wasn't the case, if it was a matter of beating, if it wasn't a matter of home country bias, then what would happen is investors would say something like, well, when Latin America is the best performing index, I want you to beat that index. And when the Pacific Rim, and when China and Indonesia and Thailand and Korea, when they start outperforming, now I want you to outperform that index or that region or area of the world. And that would just become ridiculous, wouldn't it? I mean, and I hope you're all just kind of shaking your head. Yeah, it'd be ridiculous. It doesn't make any sense. But most people don't think about these things. So when we think about beating the market, of course, 99% of you are thinking about beating your market, whatever your market happens to be. Obviously, I live in Columbus, Ohio, here in the United States. So all of my clients are here in the United States or all around the country, which means that they're thinking of wanting to beat their own stock index. Now, how often do I get this question? Not very often. Very, very infrequently. We're talking maybe once or twice a year. I'll have somebody say, how have you performed versus the market? And what I always like to tell them is, well, I've beat the market about just more than a third of the time. It's a whole lot easier to beat the market when it's going down than when it's going up. And when other stocks are outperforming U.S. stocks, in other words, when international stocks are beating domestic stocks, it's also easier to beat the market. So there have been times when, we were overweight stocks overseas in times like 2003, 4, 5, 6, and 7, when it was a really, really good time to own international stocks. And that's the chart we're looking at right now on the screen here. By the way, for those of you who are listening as opposed to watching, is it's the difference between the Europe, Australasia, and Far East index, the stock index overseas, as compared to the United States. And when you go back to 1970, there's been periods of outperformance, and I'm going to read right through them here. So back in 1971, there was 2.5 years where the EFA, it's just going to say that for short, EFA is the Europe, Australasia, and Far East, outperformed the United States. Then there was 3.3 years here, so 3 years and a third, where the U.S. outperformed the EFA. From there was another 2 years where the pendulum swung again, and the international outperformed U.S. Then the pendulum swung again back to the U.S., outperforming for 4 years until looks like almost 1983, looks like roughly. Then there was this period of time for over 6 years where the U.S. Was underperforming the EFA, and not by a little bit, by a lot. So even though it was only 6 years of underperformance versus overseas markets, or in other words, the international markets were outperforming the U.S., from the mid 80s through the late 80s, it was a huge number of outperformance. When you look at the late 80s, early 90s, 4.2 years where the U.S. outperformed, then 1.4 years, 1.5 years, the international outperformed. Then from mid 90s through 2000, the U.S. outperformed during their biggest bull market in decades. This was the Clinton era. This was the 90s, the dot-com era. And then after that market crashed, there was this period where neither really outperformed. They kind of chopped sideways until the end of 2002, after which international markets outperformed the U.S. for 7 years until the market peaked just before the mortgage crisis. Since then, U.S. stocks have been outperforming for 15 years. So when we go all the way back to 1970, we're talking more than 50 years here. There has never been a time in history where, well, I shouldn't say in history, there hasn't been a time in 5 decades where any region, call it international versus domestic, there hasn't been a time when either of these regimes have outperformed the other for longer than 7 years, let alone 15. But that's what we've been seeing. So what we're starting to see here is perhaps international stocks could be switching that pendulum back over again to where we could start to see some outperformance from overseas investments, which would mean it would be a whole lot easier to quote unquote outperform the market as opposed to this last 15 years when it's been nearly, I don't want to call it impossible, but it's been really tough. And when I say really tough, what I mean by that is when anybody says to somebody, look, the reason I'm hiring you is because, obviously I want you to beat the market. Otherwise I could just do it myself. And it's like, well, okay, well, maybe we're just not a good fit then, first of all, because I'd like to think I do a whole lot more than just manage portfolios and try to beat the market. We build financial plans. We help people get to retirement on time. We help them pick strategies. We manage the money for them. We help make sure they're staying in the strongest relative performers that exist in the market, whether that be in stocks here in the U.S., overseas, bonds, commodities, and so on. We help people when they go through job transitions. We help them when they retire. We help them when they get divorced. We help them when they get married. We help them when it comes to their estate planning needs. We help them with tax planning. So I know I'm sounding like not a broken record here. I'm just going off on a tangent. But my point is that financial advisory firms that embark or implement full-scale advanced financial planning like we do a whole lot more for our money than just place trades to buy and sell stocks and ETFs. So with that all being said, when we're talking about outperforming the market, you also have to keep in mind the fact that we're charging a fee. Now, I know some people might say, well, yeah, that's the whole point. If you're going to charge you a fee, then you got to beat the market on top of that fee. Well, think about that. That gets even tougher. So if the United States is the best performing market in the entire world, and we obviously charge a fee for what we do, if all we're charging that fee for is managing money and trying to beat the market, then wouldn't you say, and I'm looking back at this chart here, that for the last 15 years, it would be almost a losing battle to outperform by whatever that fee is, not to mention taxes, because taxes come into play as well. Because whenever, let's just say you have a brokerage account, and we're talking a non-IRA, so non-qualified account, not only are there going to be issues from the standpoint of fee, or in other words, a lagging effect usually as a result of the fee, but there's also going to be a lagging effect to the taxes that are owed on the gains from investments. And isn't that interesting? So we make money, we get taxed, and that hurts us. Well, that kind of sucks, but it is what it is, right? So anyway, I digress. But my whole point here is, and the reason I'm bringing this whole concept of home country bias up is because I don't think that most investors, first of all, think about it. That's the first thing. The second thing is I don't think that most investors realize that it is really, really difficult to beat the market. For those that care, by the way, about beating the market, when the U.S. or whatever your domestic index is happens to be the strongest and best performing index. But with all that being said, I've also mentioned earlier that we only get this question once or twice a year. So I'm not really talking to a big majority of people here. I'm talking to the minority, I think, when I talk about those who bring up outperformance or beating the market. So that when I talk about that specific sector of people or that specific group of people. But when I'm talking to the masses here, the reason I'm bringing this up is because there's a way to take advantage of it. There's a way not to take advantage of it. And there's, of course, the big, huge lesson in all of this. And let's go through that real quick. So first of all, first and foremost, the most important thing or things, I should say, three things is first, how do you avoid home country bias? And I think the easy answer to that is stop thinking about beating the market. So if all we're doing is thinking about beating the market, I think we're missing the mark. A question I used to ask all the time at presentations I used to do before COVID would be if I could tell you could do everything you ever wanted to do, you could retire when you want to, make work optional when you want to, you can hit every item on your bucket list, do all the things you want to for your family, for your kids, their grandkids, everything you ever wanted to do in your life. And all you needed to do was earn 3% per year from now until the day you die. Would that be okay? And that's the question. If you could do everything you've always dreamed of, but you only needed to earn 3% per year from now to the day you die, would that be okay with you? And there's always one person in the room when I did the presentations. There would always be one person in the room that raise their hand and say, well, no, that's not okay with me. And that's the person that maybe we're just not a good fit for when I talk about our company, our firm. But my point is that that's not the goal here. We're not just trying to beat the market. We're trying to get to retirement on time if we're not retired yet. We want to get there safely, efficiently. We want to do it in tax efficient manner. We want to stay that way, meaning we want to stay retired. We don't want to have to ever go back to work, nor do we want the stress or the worry of potentially having to go back to work. So the first lesson here is, how do I avoid home country bias? Stop thinking about beating the stock market. That's the first thing. Now, how do you not take advantage of home country bias? Well, you invest a little bit of money in every country in the world. And please don't do that. This is not blanket advice, of course. We're not giving investment advice on this podcast. We never have, we never will. But my point here is that just because you've now learned that there is this bias, and you've also learned that there's been an exorbitant amount of time that the U.S. has been outperforming international markets, and that the pendulum may be swinging, doesn't mean you go just starting to throw a bunch of money across different markets. That doesn't make sense. It would make a whole lot more sense to do relative strength calculations and determine which, first of all, regions are the biggest outperformers, and from there drill down into the best countries, and maybe even drill down from there into the best stocks within the best countries, within the best regions, within the international market, if that pendulum is sticking in terms of swinging to the other direction where international markets are outperforming domestic markets. But anyway, I'm going to shut up here and move on to the last lesson. But to bring this one home, just don't go throwing money into a bunch of different countries because it makes you feel like you're not, I guess, representing as much of a home country bias. That's the first thing, or second thing, I'm sorry. The third, and really your number one concern, is to first and foremost interview and hire a true fiduciary financial advisory firm. Now, before I finish this bullet point, I want to say that I'm not one of these people who say that you cannot manage your own money. I'm not one of these people who thinks that you can't do your own financial planning, retirement planning on your own. You can. I always say this, and for those of you who've been working with me or who've been following me long enough, know I say this all the time, and that is that you can do all this yourself. You just have to have two things. The first thing you have to have is the interest in it. The second is you have to have time. So even if you have interest in it, retirement planning, financial planning, researching the markets, I love it. I always say I haven't worked in more than 21 years because this isn't work for me. So if you're like me and you love this stuff and you have the interest, that's great. But if you don't have the time, then the interest really is irrelevant. You got to have the time to do it too. And then, of course, if we flip that upside down, if you're not interested in it, if this isn't something you love or find that you're passionate about, then you're definitely not going to spend the time on it. And of course, if you don't spend the time on it, then you're not going to like the results. So as long as you're somebody who is interested in getting help, having a guide, a coach, so to speak, somebody a professional who helps you with this kind of stuff, like us at our office, interview a true fiduciary financial advisory firm. You can find them by going to NAPFA.org. That's the National Association of Personal Financial Advisors, NAPFA. Yeah, .org. And you can type in your zip code. You can find somebody close to you. Second, construct your very own financial plan and what I call your family index. This is not the NASDAQ index. This is not the Dow Jones Industrial Average. This is not the S&P 500 index. It's not even the Australian index. It is your index. It goes back to that question I asked earlier. If you could do everything you ever wanted to do, everything you've ever dreamed of, everything you wanted, every bucket list item you've put on paper or places you've always wanted to go, if you could do all that and all you had to earn was 3.5%, 4.5% per year from now to the end of your life, and you never beat the market ever, would you be okay with that? And I think the answer for most people, at least in order to work with us, your answer would have to be yes. You'd have to be okay with being in the right portfolio, not just the one that beats the market. Because the number one reason why financial plans fail, the number one reason why retirement plans fail, it's because clients abandon their plan. And the number one reason why clients abandon their financial plans is because the volatility of the markets gets to them. It scares them out of their portfolio. They throw their hands up and they want to quit. In other words, they're in the wrong portfolio. And in order to beat the market, it's going to be pretty tough to do it without being in all stocks. So if your goal in life is to beat the stock market, my point here is to say that you have to be, well, you don't have to be, but it's going to be pretty tough to beat the market without being invested in 100% stocks. And again, what we do for our clients, we beat the market, like I said, but just over a third of the time. And I'm happy with that. And, I'd love to beat it every quarter. I'd love to beat it every year. Of course, that'd be amazing. So be sure to construct your very own, again, financial plan and your family index, which is the percentage of rate of return that you need to earn from now to the day you die to never, ever run out of money. And that's what your family index is. So it's for me to be the Koos index, the Smith index, the Jackson index, I don't know, I'm picking last names here. You get my point. And last but not least, if you already have a financial plan, or if you had one done a long time ago, but it hasn't been updated, or if you're just not feeling 100% comfortable with it, you don't have that level of trust, that level of confidence that makes you feel like you're going to make it from now to the end of your life without ever running out of money, by all means, get a second opinion. Worst case scenario, you find out you're exactly where you want to be. And at least then you have the peace of mind and the confidence to walk forward into your life, making sure that you, your family, that everything's taken care of without having to worry about it, or at least without having to worry too much about it. I don't think there's any of us who don't worry at all, but anyway. So hopefully you've gotten something out of this presentation today. Feel free to share this episode with your friends and family if you'd like to discuss your personal situation further. Remember that you never ever have to be a client to ask a question. As I mentioned earlier, if you'd like to set up an introduction call to discuss your financial situation, or if you'd like to get a second opinion on your retirement plan, head over to our website at libertaswealth.com and click the button that says click here to get started. Be sure to subscribe on iTunes, YouTube, and Spotify. And remember, you can sign up at libertaswealth.com to not only get these updates, but you'll also get access to the screencasts, videos, articles, and other things that we send to our clients delivered as soon as they're released directly to your inbox. Be sure to follow us on Facebook at facebook.com/libertaswealth. I'm also on Twitter at Adam Koos, as well as Instagram at Adam D. Koos, which is Adam, D as in David, Koos as in Sam. And as I always say, there's thousands of podcasts out there, and you chose to give ours a listen today. So thank you so much for joining us, and we'll see you next time.
Thank you for listening to the Cash Podcast with your financial surgeon, Adam Koos. To see any charts or images that were mentioned in this show, or to check out additional articles, videos, and other educational resources, head over to libertaswealth.com.